CRA just flagged 40% of crypto users as high risk last year. And if you made money in crypto, flipped a property, or worked through a corporation, there's a very good chance you're next. I deal with these audits every single week, and here's what I'm seeing. CRA isn't guessing who to audit anymore. They are pattern matching. And if your numbers don't line up with the data they already have, you're flagged automatically. This video breaks down 3 groups CRA is targeting hardest in 2026. And I'll show you exactly what triggers the audit and what actually works when they come for you. So let's get right into it. My name is Sunny Jaggi. I'm a Canadian CPA and a tax advisor. I've been dealing with CRA audits for over 15 years. Last year alone, CRA ran 69,000 compliance actions and recovered massive $15.3 billion. That money came from Canadian taxpayers. Now, Uber, Airbnb, crypto exchanges all report your income. Land registry shows property sales, and all this flows directly to the CRA. So let me walk you through 3 patterns I am seeing CRA laser focused on in 2026. These are based on what I'm seeing in my practice week after week. Number 1, real estate flipping. Here's what people don't realize. The real estate market may be down now, but in 2021, 2022, they were on fire. Huge buy-sell activity, tons of flips. CRA audits go back 3 to 4 years. And those 2021, 2022 files are still open, and CRA is working through the backlog from the hot market. They invested $73 million in real estate task force, and from 2015 to 2023, they completed about 75,000 audits and recovered massive $2.7 billion just from this sector alone. So they know this sector pays if they go after it, and they're going to do that every single year. Here's what they're doing. They have direct access to development permits, renovation permits, land transfer records. They're cross-referencing all that data for both income tax and HST purposes. And let me tell you about the new rule that the government recently introduced in 2023. It's called the 365-day rule. If you buy and sell any residential real estate property in Canada and you sell it within a year, CRA automatically treats it as business income, which means you can pay up to 54% in taxes. I had a client who bought a pre-construction condo in Toronto, sold it 8 months later for profit, and they reported as a capital gain because that's what they thought it was. CRA got the land registry data. They saw the timeline. They saw they only held the property for 8 months, and they reassessed the entire thing as a business income. Their tax bill went from $12,000 to $47,000 plus interest and penalties. There are exceptions to these rules, such as death, divorce, disability, job relocation, and insolvency, but you have to prove it. The burden of proof is on you. And here's the part that destroys people, which is quite unexpected. It's the HST bomb. When CRA reclassifies your flip as business income, you're not just caught from an income tax perspective. They're going to look very carefully if HST applies to that situation. And sometimes it does. And if it does, there's going to be 13% of HST tacked on the value of the house, which you may have to pay. Most people absolutely have no idea when this comes. When CRA nails you for both in the same audit, income tax and HST double hit. We actually have an upcoming video on this very real issue where we have seen a horror case. It will release shortly, and you should subscribe to see what actually happened and how we actually got away from a bad situation. And then next up within the real estate is your principal residence pattern. This is one of the few tax-free items left in Canada. Sell your principal residence, pay 0 tax on the gain. So people use it. Buy a property, renovate it while you're living in it, sell it. Claim the tax-free principal residence exemption, pay no taxes. And then you do it all over again. Buy another property, renovate, live in it, sell, claim the exemption again. Technically, if you are genuinely living in each one of these properties as your principal residence, you are entitled to that exemption each time. But if you're doing this 3 or 4 times in 5 or 6 years, CRA is going to argue you're not living in those homes. You are running a house flipping business in disguise of principal residence. And if they win that argument, it is going to be a disaster because all of those sales will be reclassified as business income. All the profit will be fully taxable. Plus, they may even tack on 13% HST on each particular sale. This gets tremendous attention from CRA every single year because it is one of the last tax-free shelters available. So what do? If you have flipped a property in 2022, assume you're in the audit queue. And if you have run into this 365-day rule that was introduced in 2023, make sure you go back and look whether or not you have reported something incorrectly. And if you have used principal residence exemptions multiple times, make sure you document the evidence about how you actually lived in the property. You might have utility bills to support the activity. You might have moving bills. You might have bought furniture. You might be getting your mail. Have all of those evidence documented for yourself. If you ever need to use it, you can always give that to the CRA eventually. The second pattern outside of real estate is going to be the incorporated employees. CRA is just about to go after the truckers. And I think once they're done with the truckers, I personally think they're going to go after IT consultants and construction workers. Here's a structure and how it works. Instead of being on your employer's payroll, you simply incorporate a new company. And that company basically invoices them for your work. The employer saves massive. They don't have to pay CPP contributions, no EI contributions, no WSIB. They don't have to pay you vacation pay, no benefits. That's going to save a lot of money for the employer. You, on the other hand, who has a corporation, you might feel that, look, I will be paying low corporate tax rate, which is 12.2% in Ontario instead of personal tax rate, which could be up to 54%. Sounds great, right? Except there are rules specifically designed to stop this. It's called PSB, Personal Services Business. If CRA classifies you as a PSB, here's what happens. Your tax rate in the corporation jumps from 12.2% to 44.5% in Ontario. And you can only deduct two things as your expense from that company: your salary that you pay to yourself and legal fees to collect the payment from your employer. Everything else gets denied as expenses. No vehicle expenses, no fuel, no meals, no insurance, no office expense, no equipment, nothing. And if you've been claiming these expenses for years, CRA will deny you all of them at once and reassess going back multiple years at a higher rate of 44.5%. This crackdown is just about to happen. Another evidence that because it's going to happen is in December 2025, CRA lifted the T4A penalty moratorium, specifically for the trucking industry for now. That means every trucking company now has to report any payment they're making over $500 to any contractor. That includes drivers, anybody that's working with them, on a special T4A slip. And if they don't report properly, they're going to face significant penalties on each time they fail to do it. Government just allocated $77 million and gave it to CRA so that they can go after this trucking enforcement specifically. This is a very, very low-hanging fruit for CRA. They're going to be doing this, and it's just not going to be the truckers. It's going to expand into other sectors which are very prone to this types of issue. It's going to be the IT consultants, and it's going to be construction contractors, construction workers. Anyone incorporated but working like an employee, they are going to be exposed. I did a full breakdown of PSB in my video, which was geared toward truckers. It's called CRA is Coming for Truckers. It's in the description of this video, but basic same principles apply across all industries. So if you run into this issue, what do? Work for multiple clients. Have 3 to 5 different companies throughout the year that they're billing. Get a written contract with your employer. Show how you control how the work gets done. Own your equipment. Hire a subcontractor and employees of your own. Show you're running a real business, not acting just like an employee. Quick note, in a couple of weeks, I'm releasing a full podcast episode. What 53,000 CRA employees are actually doing. We go deep on real CRA audit stories, how CRA audits actually unfold, what power CRA has, and how and what they don't tell you. It is going to be one of the most interesting episodes we have done. Link will be in the description when it drops, but you should subscribe so you get to know when it drops. The number 3 big item that I think CRA is going to go after in 2026 is going to be the cryptocurrency. CRA has now forced crypto exchanges to hand over customer data through court orders. They're analyzing it and they've looked at it and they think 40% of the crypto users are either high risk or they're actively just evading taxes. They now have a 35% enforcement team. That team just showed that they can collect, and they collected big. In the last 3 years, they collected $100 million just from crypto audits. Here's what's catching people in the first place in crypto. It's unreported income. Unreported income could be in crypto, such as staking. If you're staking a crypto such as Ethereum, you're earning rewards. Most people think those rewards don't count as income until you sell them. Wrong. CRA's position is clear. Staking rewards are the income the moment you receive them, not when you sell them. And if you're getting staking rewards every few days, every single one of those transactions is taxable at fair market value on the day you get them. Then when you sell your crypto, whatever capital gain or loss you have, that's on top of that. Most people aren't tracking any of this. They're just letting rewards pile up. They're not making any documentation or keeping records. And there's no fair market value records also. So when CRA audit happens, they are not able to reconstruct any of it. Second problem in crypto is missing your cost base. If you bought Bitcoin in 2017 for $55,000 and you moved it between exchanges, you may have lost track of the cost base. And if you sold that same Bitcoin in 2024 for $100,000 and you made a profit, the problem is you may not be able to prove what did you originally pay for it. And CRA position on this is very clear. If you cannot prove your cost base, they will assume the entire 100% of the sale proceeds are taxable. So instead of paying tax on a $100,000 sale minus your cost of $55,000, resulting in a profit of $45,000, they're going to tax you on the whole thing. And that tax bill could be $27,000 versus just $12,000. And here's what's also coming that most people don't know about. Canada has adopted international standard for crypto reporting. It's called Crypto Asset Reporting Framework, short form CARF. Starting in 2026, crypto exchanges will be required to report everything to CRA. Every wallet address you control, every transaction over $50,000, and that's automatically going to be shared with over 100 countries. It's an international coordination to battle the non-reporting of income when it comes to crypto. If you think CRA doesn't know about your crypto now, they will definitely know by 2027 when the first reports start to come in from this effort. And if you get hit with crypto audit today, CRA sends you a 54-question, 13-page questionnaire. They want to know everything about your crypto activity, every wallet you've used, every transaction, every staking reward. They go back last 6 years, and most people don't have records going back that far. And when you can't provide any information to them, CRA assumes the worst case scenario for you. 100% taxable, no cost basis, and no relief. What do you do in this case? First, go back and look at your crypto income. Are you properly reporting staking, mining rewards, proper buy-sell transactions, calculating your capital gains properly, your income properly? You should look to use crypto tax softwares. A lot of them are now available in this day and age. And if you're missing previous years or you did not report properly in the previous years, go back and disclose everything and use CRA's relief program. It's called Voluntary Disclosure Program. Because if they haven't contacted you yet, you can still use this program, and that will give you interest and penalty relief if you're going to be exposed to it. We have recently done a long form podcast on Voluntary Disclosure Program. We describe how it works, what is it, what information do you need to provide. The link of the video is in the description. Now, let me give you a practical advice for when an audit actually starts. First, provide only what's being requested. Don't just volunteer extra documents. Don't volunteer extra years of documents. Every extra piece of information you give them, that can expand the scope of the audit. Second, request a 30-day extension. It's a standard practice. CRA rarely ever refuses it. Use that time to get organized and get advice before you respond. Third, for large amounts or complex situations, get a proper tax accountant to represent you. Not just a generalist accountant, someone who understands the Canadian tax law and the numbers really well. Here's a stat nobody tells you. Based on CRA's own objection data, taxpayers who fight back win or partially win 55% of the time. Look, CRA is powerful, but they're not perfect. They make mistakes. They misapply rules. And if you have documentation and professional representation, you have leverage. Don't just accept their assessment as final. Those are the three groups CRA is coming after the hardest in 2026: crypto, real estate flips, and incorporated employees. One more thing. I just released our 2025 Canada Tax Wrap episode. Think of it like Spotify Wrap, but for tax. We look at how CRA performed this year and Finance Canada did. The overall theme, a lot of uncertainty, and Canadians were frustrated with CRA, and for a good reason. That episode breaks down what 2025 actually looked like behind the scenes. Link is in the description again. And here's the bottom line for 2026. If you are in one of these three categories, crypto, real estate, or working through a corporation, assume they have your data, platform reporting, land registry, exchange data. It's all flowing to them now. Before you go, drop a comment. What audits are you seeing? What are your top 3 predictions for CRA audits in 2026? I want to hear what patterns you're noticing out there. And if you've been through a CRA audit yourself, share your story below. Others will learn from your real experiences. Knowledge is power. Protect yourselves. Thanks for watching.